Good afternoon, True Door clients. Today, I have two special guests with me, and the purpose of this webinar is to help you guys explore different strategies. I know many of you reach out to me with many different questions when you're thinking of either selling your current asset to buy another one, or you're just considering growing your portfolio by adding more properties, right? Whatever the options are, we're here to talk about 1031 exchanges, and I have Dana here, who's my preferred title rep. Many of you might have met her already in the past if you worked with me. She's been your title rep throughout the process. And we also have Charles Jensen, who's a 1031 exchange expert, and he's here to talk to us about that and why you should be considering 1031 exchanges if you're having thoughts of selling or, like I said, adding more to your portfolio. Thank you so much, Charles, for being here. I'm going to hand it off to you. But first, let's have Dana just introduce herself real quick. If you haven't, dealt with her, I'm sure at some point you will meet her.
Yeah. Hi, everybody. It's a pleasure being on here. Thanks for having me, Stephanie and Judor. So I'm with Old Republic Title. We are one of the top 3 title insurance companies in the nation. And I've been doing this for over 10 years. I love being in this industry and helping people. And I love when we're able to help financially with our clients, right? And help build their portfolios and expanding, or just find out what's best for you. On the title end, if you ever want help, looking at the vesting for your property and the deed and just verifying what it looks like, be happy to look into that. And if you need help with anything, you can always reach out directly to Stephanie and she can contact me. But I'm really excited to hear from Charles. He's got some great information, and this is all just education to help you and give you more options on capital gains. So
that's right.
Thank you.
Thank you, Dana.
Thank you.
It's nice to be here today with both of you, Dana and Stephanie, and we'll talk about who my company is first, Inland, for a few minutes, and then we'll go into the basics of 1031 exchange. Make sure we're all on the same page because we come from different education levels of understanding, and we'll talk about the Delaware Statutory Trust, which is a vehicle for exchanging. It's one of your options when you're doing a 1031. In fact, I find about 97% of average people do not know about a Delaware Statutory Trust or a DST. Even accountants don't know because the tax code is so vast. And then we'll go over this, give you some more information, give you a better understanding of the DST and how it works. My information's here. If you want to pull me in for consultation in the future, you can text me 424-291-0064. I have a QR code where you can pull my information, much like a menu at a restaurant, and grab the whole business card. We can end with this as well too. So I'm going to move forward here into our presentation on utilizing DSTs in a 1031 exchange, which is the title of the presentation today. And I know this is kind of a panel discussion too, so I'll go through here. Feel free to interrupt at any time to ask any questions. Just disclaimers and risk factors. We know that the past performance is not indicative of future results, so always read your private placement memorandum, usually a couple hundred pages long. And it goes over risk factors as well. So it's a good thing to look at. Who is Inland? I say the word Inland in California, and everyone thinks the word Inland Empire somewhere, which is no problem with that.
That's what I thought.
It's not Riverside. It's not in Temecula. It's 4 Chicago teachers that met in the 1960s that wanted to make more income than an average teacher at $6,000 a year back in the 60s. Wow. They decided to band together at the same school in South Chicago to buy real estate. Because think about the 60s and do a business. No cell phones, no Instagram, right? No email. It's a little bit harder to communicate. So they worked at the same school to communicate better. And when they did so, they started buying real estate. And their first deal was a piece of land. They found a $4,000 piece of land. They each forked up $1,000, which is a lot of money at that time. Put $1,000 up each and invested into the land because it's hard to get loan on land, right? They built a 4-unit apartment building. And they sold it shortly thereafter. It was constructed for double their initial investment. So you can imagine the other teachers not making much money saying, hey, can we get on the next deal? They couldn't hide what they're doing because they were using the faculty lounge phone, right, in the break room. It's corded, bunch of couches, maybe some people smoking cigarettes, crowded together. I don't know how that looked. But you can imagine that they had no privacy to make phone calls. So they had their first deal. Second deal was more teachers. Next deal had more teachers. They turned into like a CalSTRS, if you will, all these teachers unionizing together to buy real estate with their direction. And within 5 years, they stopped teaching stopped teaching school and went full time into real estate in 1967. They kept buying apartments, building apartments. They created a management company. We even had our own trash company where we did all the trash maintenance, everything on the properties. Over the years, the 60s, 70s, 80s, 90s, they bought retail, office, industrial, medical storage, more apartments. By 1989, we became the biggest landlord of Walmart nationwide. So 4 teachers that came from almost nothing, lower to middle income class families, became the largest landowner of Walmart nationwide. We own the land, the buildings, leased it back to the Walton Family Trust. Today, Inland is in the top 10 of the largest commercial property owners in the U.S. and the top 10 landowners in the U.S. And we're the largest sponsor of the Delaware Statutory Trust and securitized 1031 exchanges in the nation. You're going to recognize a lot of properties we own. Even though you recognize our name, you'll recognize what we own and who we are just by some of the properties we talk about today. So why do a 1031 exchange? Exchanges started back in 1921. And a 1031 exchange allows you to defer your taxes on the sale of any investment property. So let's say you bought an investment property years ago for $100,000 and you sold it for $1 million today. What kind of taxes are you looking at, right? And you're going to run to 4 major taxes. The first tax, if you did not do a 1031 exchange, is recapture of depreciation. So you know how you can fix things and get tax breaks on a property? The IRS will claw back up to 25% of their tax breaks to you when you realize the gain. So if you got $100,000 in tax break at 25%, it's a $25,000 bill from the IRS. The hidden tax, this is the one you're not expecting. The federal tax you are expecting, right? 20% on that million is $200,000. State taxes, state level taxes, you'll see where it says 5.1%. What state is that, right? That's actually the average of all 50 states in the nation, which reminds you how high our taxes are in California. We're the highest state level taxes in the entire nation at 13.3. So forget 51,000. We're closer to $133,000 being in California, our tax situation. And then the Medicare that helps, it's the tax on investment real estate, the sale of investment real estate that funds Medicare at 3.8% or $38,000 on the million. So your $1 million could leave you with only $686,000 after taxes. But in California, it's a higher tax bill, right? Because it's not $51,000 at 5.1%. It's $133,000 potentially at 13.3. So your $1 million could leave you closer to $600,000 or a 40% potential hit in California. Utilizing Section 1031 of the code, if you exchange it into another investment property, you'll defer all of your taxes, right? Your state, your federal, Medicare, and recapture of depreciation, right? So your full $1 million is working for you. Think of it as like your 401k of real estate. Would you ever cash your 401k in? I wouldn't advise on it, right? Because you're going to pay a lot of taxes if you were to cash in your 401k.
Unless you're cashing out to buy real estate, right?
Yeah, right. There you go. That's for real estate. But
right.
in a way, the 1031 exchange is like the 401k of real estate, where
exactly.
your $1 million is now giving you income versus 600,000. Some people say, "Oh, I'll pay the tax and go into some treasuries or stocks, bonds, or mutual funds," but it's exponential to catch up when you're $400,000 behind. You know, so why not have all the money working for you? And this exchange might be 100,000. Maybe that grows to 2 million next time. You can exchange that, and you're tax deferred. It grows to 3 million. You exchange that. It grows to 5 million by the time you die. What happens upon death? Now you're at $5 million. You bought this property for 100 grand years ago. You're at $5 million. You have a huge tax bill. Your kids, your heirs get to step up a basis to fair market value. The taxes go away. So when you pass away with real estate, the taxes go away and your heirs inherit it at the current market value. How cool is that? So in exchange, you can swap until you drop, defer until you die. And upon death, the taxes are eliminated. How cool is that? That is how the rich get richer in this country, and how people build empires is by deferring their taxes, never realizing the gain, and living off the income, kind of like an annuity in a way, right, of real estate. Right. Now, one thing is when you sell your property through Stephanie, do the title work through Dana, right? Your funds have to go to a third-party qualified intermediary, or a QI as we call it, right? And the qualified intermediary, what makes them qualified is it can't be Dana, Stephanie, or myself. It has to be someone impartial to the transaction, right? It has to be someone that's not tempted to backdate some of the federal timelines that are in the next slide. That's what makes them qualified. And we know a bunch of QIs out there because your funds can't go directly into escrow. They have to go from the sale directly into a qualified intermediary. If your funds at escrow, the exchange is blown. It's a really big part of this. And these qualified intermediaries charge a fee, typically $1,000 to $1,500 to do your exchange. It's not too crazy, but just find one that's licensed and bonded that's out in the market. Now, this is the biggest thing. Day one is when you sell your property. The IRS puts certain timelines in place. I think part of it is they didn't want everyone doing an exchange. Day one is when you sell your property and your funds go to the qualified intermediary, right? It starts that 45-day clock. You got 45 calendar days, includes weekends and holidays, to identify your replacement property, right? So Juneteenth would have counted, this weekend would have counted. 45 days is not a long time. You have 180 days to get it closed. So 6 months to close it, 45 to find it. What's the harder number you think?
The 45.
45, right?
Right.
Ask any realtor, they'll tell you the 45. And part of it is the fact that there's a historically low inventory of properties in the market. A lot of people are holding mortgages at 2-3%, right? But there's also issues. I live in Manhattan Beach. We have a lot of kids moved here from the Palisades, and a lot of people absorbed our real estate locally, because of schools and stuff like that, and the fires, displacement. So 45 is a hard time frame for most people. In the Delaware Statutory Trust, which we'll talk about today, will explain to you that the DST, we've already bought properties in advance you can exchange into. We're not worried about 45. We're not worried about the 180 of closing it because we're already closed and ready to go, and due diligence has already been done. So it's a huge advantage for people in today's market by selling their property and looking at a 1031 exchange for their next transaction possibly, right? And to complete a successful 1031, the property has to be considered like kind. You can't just exchange any property. If you're living in the property right now, it's not considered an investment property. It's personal property. So you'd have to move out of it, right, for a couple of years, right, Stephanie, to change it into a qualified property for a 1031 exchange. So think about the DST is the investment vehicle, like the IRA of real estate, right? It's your vehicle that's tax deferred, and it qualifies for 1031 exchangeability, right? It's like kind. So in 2004, the IRS created the Delaware Statutory Trust. Now, like kind also means you can go from apartments and exchange into healthcare to self-storage. As long as it's held for investment, you're selling or buying into property. So the DST qualifies as an investment property, right? So when you do a DST, it's not much different than a typical exchange. Step one is you sell your property via your realtor, Stephanie, right?
Right.
So we don't buy the property from you, it gets sold via your realtor. Step two, the funds go to the qualified intermediary that triggers the 45-day clock. Between step 2 and 3, there's usually a financial advisor involved we can help out with to do the paperwork to exchange into a DST. So 1, sell your property. 2, fund goes to the qualified intermediary. 3, the financial advisor helps you exchange into the DST through paperwork. Now, there's 6 major advantages of a DST. We'll go over the advantages. There's always pros and cons to every investment. We'll go over both of those today. But the first pro is access to high quality properties. Let's say you're selling $1 million property today. Let's say it's Los Angeles, right? In LA, what's $1 million going to get you anymore, right? It's not always rainbows and waterfalls, whatever they call it, right? It's sometimes deferred maintenance and roofing and issues you got to deal with, right? Sometimes buying out a tenant. In a DST, you can invest for as low as $100,000. We could have my $100,000, Dana's $1 million, Stephanie's $10 million, times 500 people's needs for exchanges. So in a DST, we're dealing with hundreds of millions of dollars. So for example, we own ESPN's headquarters in Bristol, Connecticut. It's an Inland property. Inland owns AT&T's headquarters. It's a DST. Verizon's headquarters is a DST. You get the idea, right? Could be student housing facilities. If you go past USC on the 110 these days, there's a rooftop pool property next to the soccer stadium. You'll see it a million times over. It's one of our properties. Could be apartment buildings. Could be healthcare, senior living facilities, hospitals. Could be self-storage facilities. Our view today is there's 4 core areas of real estate, and commercial real estate at least, right? Retail, office, industrial, multifamily. And 2 of those areas have been hurt in the last 10 years, namely COVID affected office space, and then retail has been affected by Amazon. So notice that we're showing these asset classes. The reason these asset classes is that we want to buy something predictable. We know there's a silver hair tsunami of baby boomers retiring through the population by what, 20, 30, 22% of the population will be over 65, and they're going to need apartments because they want independence, but they don't want to be in an assisted living facility. Where's their stuff going to go? Self-storage facility. Where they go after apartments, into senior living, right? The kids go to college at tier 1 universities is what we're looking at. Or it's an Amazon or a FedEx type property or sell lease back on an ESPN. So we're staying away from the general office buildings and retail because it's hard to predict. In today's market, you see a lot of vacancies in those spaces. Walk around any mall, older malls, right, of today.
And I would say, just to add to that, one thing I've noticed too is with multifamily, you can do a 1031 exchange, let's say from a single family home to a multifamily property that has ADU potential, which is something that we've also helped clients with, right? I, as a consultant, can help check and see what's feasible. And sometimes that's another additional 2 units, 4 units. Let's say you're also in the position of considering a 1031 exchange and you want to sell it vacant because that's going to help your process. That's one thing I always tell my sellers is you want to try to work with the tenant and get them out sooner than their current lease, right? Because the property will show a lot better vacant, which is going to help you meet all of these other timelines as well. So just wanted to point that out there if you're in California, but really anywhere. And I'm also licensed in Florida now. So sometimes it may make sense to do a 1031 from California to South Florida, right? Consider buying an asset that has a lot of value add potential, like multifamily and some of the other asset classes that you mentioned.
Exactly. And I moved from Santa Monica, had 2 ADUs out back, which is awesome. I actually converted a garage from the 1940s and
Nice.
like 2 different apartments. And it was awesome to sell the property at the end of the day. Because I think I was there during the change of the rules too, where they allowed for more because of the lack of housing, right?
Right. I mean, we were doing it. I was just staying at an ADU in Hermosa Beach last week because I have about 8 units that I manage there. They're all midterm rentals and 2 of them are ADUs. So, and a lot of them, you know, Hermosa Beach, Manhattan Beach, to your point, because of Pacific Palisades and Altadena, you know, you're getting a lot of influx of people moving to those neighborhoods. So midterm rentals are also a good option when thinking about an exit. So yeah.
There's one main public high school in Manhattan Beach, and my son goes there, and they have 133 new kids in the Palisades. It's not wild.
Wow.
You can imagine the absorption.
I figured they were either going to send them to Manhattan Beach or, I mean, like, what's the next competing neighborhood?
I think it's similar because it's good schools. It's not
right.
And I think also it's a community that's on the ocean,
right?
Kind of like, you know, like Palisades, different, but you know, similar in certain ways. So
yeah. So with that, I mean, there's going to be an influx of people moving from LA to Orange County, right? People wanting to, just kind of move to that area. So that also helps.
You're feeling some of that. Even living here, you can see where some of that flow of, you know, a lot of stuff happening in LA is kind of trickling down. It's pushing people down south.
Mm-hmm.
So it's interesting.
And it doesn't matter what price point. I showed a $10 million property in Hermosa Beach, and it's been on the market about 10 days, and they already had a prospective buyer from the Palisades. House burnt down, lost the business, lost everything. But they didn't think, you know, the builder really didn't think that he could get 10 million for it, but the demand is there. So it doesn't matter what price point you're in. I think you should consider, you know, getting that top dollar in this type of market. Unfortunately, for those people who are impacted, but for you, right, this is something you should consider if it's an investment. And sometimes if it's an investment property for your kids, right, that's also an option. I think I had a conversation with a client who was wanting to do a 1031 exchange from Orange County to Nashville. And I was asking her questions and I said, well, are you going to rent it in Nashville? Like, she didn't know about a 1031. So I was kind of proposing that for her. And she said that she was going to rent it out to her daughter. And I said, well, as long as you have a lease in place and, you know, you're actually going to rent it out to her, that's another hack, you know, that most people don't think about. As long as you're renting it out and you're not living there, you're renting it to someone and you have it in writing, it's considered an investment, right, Charles? Or is it
as long as you move out of your property, you rent it out for a certain amount of time, you can turn it into an investment property pretty quick.
Right.
It's not a dumb move. It's probably smart to move out a couple of years, find a new property, rent it for a couple of years, and then exchange it at some point. And that's to the next 2 bullet points, talking about the Palisades is a good example. One thing is there's no management responsibilities in a DST. So if you've ever managed a tenant, you deal with the terrible T's, right? The tenants, the toilets, the trash, turmoil, termites, teenagers, taxes of managing a property, the terrible T's, right? And in a DST, you sit back and collect the monthly income, but there's no management. You can't have management within 500 people, right? Trying to manage a property, it'd be chaos. So in a DST, we handle all the terrible T's of management. You sit back and collect the income without the hassle, because again, it'd be too hard to get 500 people trying to manage a property together. I think that makes sense, right? So no management in a DST. You're in a passive situation. You collect the income off the property, right? You collect the income, and every month in a direct deposit, you get a monthly statement, you get a quarterly update. At the end of the year, you get a 1099, not a K1. K1s are notoriously late. 1099s come on time. You plug it into your taxes. It's super easy. So for me personally, I have 3 different DSTs. Every first of the month, I get a direct deposit, right? Monthly income, direct deposit at any account you want it to. So you're not running after rent collection, right? Water heater blows up in the middle of the night. You're not dealing with the water heater issue, right? So in a DST, you're out of that management. You sit back. You have all the upside without the downside of managing the property as you're going, right? That being said, when you look at a Delaware statutory trust, you look at these types of situations. You have very passive income without the hassle in general, but you're just not having to worry about the liability of a slip and fall because it is a trust as well, or these different things. Now on your taxes, you still owe income on your taxes. Any rental property that spits off income, you're going to pay tax on that, usually what they call ordinary income. But all of the depreciation, all the write-off of the properties pass you through the 1099. So you're not having to sit there and worry about that. But in addition, most people depreciate property over 27 and a half years. Our average DST is 5 to 7 years in length. And in doing so, we bring our depreciation to the front of the deal. We do cost segregation where we actually look to see the real depreciation of things. Instead of pulling it over 27 and a half years, we pull it to the first 7 years.
And I think a lot of people overlook what cost segregation is. So maybe give them a little bit of a definition of what that means.
Yeah. So cost segregation is when you look at a building and you divide it over 27 and a half years of depreciation. It's kind of lazy, is it not? Because you're just assuming everything depreciates equally. Well, wouldn't pipes be different from electrical, be different from concrete walls and windows? Everything has a different depreciation schedule. So we walk in with a clipboard and figure out the real depreciation on everything and give it its real time frame. So we find out every depreciation the first 10 years, we pull to the front of the deal. And it gives you maximum tax write-off, right? Does that make sense on how that works?
Yes. And us as a property management company, we have access to that, history on the property. So that's also something we would be able to help with.
Yeah. Exactly. So it just gives you options here. You don't have to worry about all these different things. And again, taxes are in a with a bow on them, in a package, and you don't have to go out and find out receipts. It's taken care of. So all you have to do is plug it into Schedule E of your taxes. Schedule E is the portion of your taxes where you put rental income on a property. So again, it's all figured out for you in advance. All of your write-off is figured out. And here's kind of an example. This person owns 2.7% of the DST. They got $77,000 a year in income, but it's offset if there's a mortgage on the DST, as well as if you have depreciation left over. If you sold a property that depreciates in 27 and a half years, you sold it in the first 15 years, you still have a good amount of years of depreciation left over, correct? So that's going to offset your ordinary income here in addition to any of the tax write-offs. What I'm trying to tell you is it's very tax efficient in a DST. It's going to up your income because it'll offset more of the taxes. It'll make it feel like it's more income too. And diversification goes back to your Palisades comment where I knew someone in Redondo that owned 2 investment properties in the Palisades. And they had recently put in about $400,000 each property in upgrades, and it burned. They were usually literally staging the homes the day of the fire and burned, right? So they out. Awesome. Yeah, it's going to cost probably bankruptcy for this person. But the thing is all their eggs are into one basket, and you never know what's going to happen. A flood in Texas, a hurricane, an earthquake, a fire, anything can happen. So what we do is we diversify to mitigate liability and risk, right? So in a typical DST, you might have that one ESPN headquarters in Bristol, Connecticut, or that one, FedEx property. But a lot of times we have, for example, hypothetically, three apartments in Tennessee in one DST portfolio, different areas of Tennessee. There's no one of them that's going to take all three properties down, right? Or it could be 5 senior living facilities in Arizona, right? Diversified within Arizona, or 10 storage facilities in Texas. So imagine you sold $1 million property. You can go into multiple DSTs. You can go to 3 different DSTs if you wanted to, right? Under the 3 property rule. You can put a third of your money into 3 apartments in Tennessee, a third of your money into 5 senior living facilities in Arizona, and a third of your money into 10 storage facilities in Texas. You went from 1 property, 1 city, 1 state in California to 18 properties in 3 states and 3 asset classes. Do you see the diversification, how tremendous it is? And we're trying to mitigate the risk. And when we sell these, we sell all those apartments together, all the storage together, to a pension fund, a Blackstone, to a sovereign wealth fund institutional buyer, a REIT that wants to buy a portfolio and not just an individual property. A lot of times they're willing to give you a premium.
That was one of the questions that came up. So I'm glad you answered that.
Yeah. And in fact, the average DST sells in 5 to 7 years. My last DST was 3 years, but it could be 5 years, 7 years, could be longer, could be shorter, depending on market cycle. We've done 230 full cycle DSTs start to finish. And the average has been about 6 years is the average real estate cycle. We see something bought and sold, which is probably pretty common. People owning homes is 6 years. I think my last house in Santa Monica was 6 years and I moved out. It was almost to the point of market cycle.
I think it's gone up to like 20 around where we live now. It's like, yeah, it's pretty long now. So just like quick question, when you're sitting down with somebody that wants to do a DST, what does it look like when they're trying to decide like what to invest in, right? Since they've never done this before, possibly. And you said you can put it into 3 different ones. Like, what does that look like? How do you help them determine which one would be best for them, the risk mitigation and all that? What does that look like?
Yeah, we ask questions about, their finances, how much liquidity they have. Is this all your money? Is it all into one basket here? And we find out their tolerances for risk. And based upon that, they may have their own preferences. They may say, because we look at apartments, bed, sheds, and meds. Apartments, self-storage, assisted living facilities, student housing. We have certain things after that silver hair tsunami of the baby boomer generation we're looking at. They might say, I really hate storage facilities. We'll say, well, why? They might say, well, it's the management. We're not in the management, right? But we'll figure out what it is. But based on what we have, it's a menu that's always changing. It's like going to that restaurant where the menu is a little bit different every month because it's a closed fund. When those 3 apartments in Tennessee sells, the next DST might be 3 apartments in Texas, might be 3 apartments in Arizona or Colorado. It's going to be in a different place, a different little vibe to it, but very similar because it's closed-end, meaning that a mutual fund's like open-end, where it's buying and selling properties in and out of it. This is like it's set sale. You know what you own. It's going to go on. It's going to go off set sale, not on sale. Set sale for the next 5 to 7 years on its journey, through exchange land. But here's the biggest thing I think about right here is in exchange law. If you sell $1 million property, you have to go back into $1 million real estate, equal or greater. What happens if you sell $1 million piece of real estate? You go to $800,000 piece of real estate. The $200,000 did not exchange is taxable. The $800,000 is tax deferred. So you need to go equal or greater. You can exchange up in value through more debt or more equity and defer that, but anything less is considered taxable. So let's take an example. Let's say your average investor is selling a property. It's $1 million, okay, in Orange County, for example. They're selling $1 million Orange County property, and they have a $500,000 mortgage on it. So half of it's debt through a mortgage, half is equity. What happens when they sell the property? The $500,000 is paid off to the bank instantly. Escrow, wires those funds, banks, loans paid off. It's all done, right? And so what's left over? $500,000. It goes to the qualified intermediary that goes into your exchange. But see, you have to get back to $1 million to be deferred, fully deferred. So most people have to go get a new loan from Bank of America or wherever they bank with, right? Get new finance. You can come out of pocket the $500,000, but most people don't have that laying around, Right. If you do, please call my number. You saw it first. No, I'm teasing. Halfway serious. But you know what I'm saying, right? So this is the biggest problem. Two biggest problems is finding the real estate in today's market in 45 days and closing on your loan, locking your financing. If anything falls apart, you're burned. After 45 days, you can't re-identify a property. In the DSTs, can you imagine how hard it would be to get everyone approved for financing? 500 people. We got your credit score, Dana, your credit score, Stephanie, my credit score, times 497 other people. It's time consuming, would cost a fortune. The IRS realizes this is not efficient for anyone. So the IRS allows Inland, the sponsor of the DST, we bought the real estate you're exchanging into, we're allowed to put the loan on the property. We buy the property in advance. We put the financing in advance through us. So ESPN, real example, was bought for $50 million. I think it was 55 they wanted for it. We got it for 50 with all cash. Then we added financing at 25 million. So we paid 50 million in cash to get the deal. We added leverage of 25 million loan from the bank. That's a 50% loan to value. So if you're selling out of a 50% loan to value, AKA 500,000 on a million, 50% loan to value, you could exchange into our 50% loan to value DST, equal or greater. So some of our DSTs have no debt. For people that don't have debt, don't want it, don't need it. Some DSTs have 40 or 50% debt, even up to 80%. The idea is, let's say you have 25% debt level. You have $1 million property, 250 in mortgage, 750 in equity. You got to get 25 or higher on your buy side. What you could do is put half your money to a zero debt Amazon hypothetical deal. Hypothetically, 50% of your other half your money into a 50% loan to value apartment deal, 3 apartments in Tennessee. You got diversification, 50 and 0 averages out to 25, right? When you blend that together, you can blend it. Or if you take on more leverage, it's not your debt in real life. Your credit score is jumped up because it's not on your books. But since your loan is paid off and your credit score went up, you could probably get more financing other places, but you're going to get all the tax benefits of that passed you through the 1099. All the tax benefits without the liability and the recourse of the loan. And you don't have to get approved. There's no approval process. There's no documents needed because it's our loan, not yours. We don't care about your credit score. So that's huge, right? Because we have the properties in advance in a DST. We have the financing done. You don't have to worry about any of that going into a DST. Make sense?
So how many properties total do you have right now? I'm just curious, what does this look like?
Usually we have about 3 to 5 properties at any given time you can exchange into at different debt levels and different asset classes. So it's just always changing. Every 30 days.
Diversifying that as well, right?
We have about $500 million in new real estate coming out in the next 60 days, to give you an idea. Wow. So we're very bullish on the market and the demand, because the demand
this is definitely an option right now, because as we talked about it a little bit, the market is in a very interesting place right now, is how I can put it. Some properties are selling over the weekend. Some of them are taking 30 days. It's very rare. It's a very unique way doing business right now. So, having this as an option is good. And if not, at least identify where you're going to transfer your 1031 to, because that 45-day period really, hinders people in being able to do that successfully.
Well, Steffi, with that comment, let's jump to the insurance policy at the bottom. You see that insurance policy one?
Yeah.
The bottom. Let's jump there for a second. You said something important there, because as a realtor, let's say you're helping a client in Irvine that's selling a property, find another property in Irvine. They're working on property number 1 through you. They can put property number 2 and 3 as a DST, as backup. In case property number 1 falls out of escrow, it's like musical chairs. You can change identifications every day in the 45 days. Come day 46, if you fall out of escrow, that property's gone, you have nothing. If you had 1 property and you have 2 others, you have a DST, So right. It makes sense to back yourself up. It costs nothing to hit up Inland and say, I want to identify these 2 different DSTs as a backup, just in case you fall out of escrow at some point. But another thing too is,
a lot of deals are falling out of escrow right now. Like, a lot of buyers are canceling because of insurance policies as well. So you got to take that into consideration, because you may have your future property identified within the 45-day period, but your current escrow may cancel on you, because that's, cancellations are up. What was it, like 17%? You said?
Yeah,
At least
Something-
it's going higher every week.
I
Right?
know it's high because I've been doing this for a long time and I've seen a lot more cancellations this year than in the last 15, right? So yeah.
The market changes on a dime, right? Whether it's tariffs or what's going on in Iran.
Exactly.
A lot of things, there's a lot of motions in different directions, but I predict the moment the rates start to come back down, you're just going to have a flood of people coming
Of course,
back.
because the demand is still there. The buyer pool is still there. It's just that only a fraction of them are qualified to tap into this type of market with these rates. So,
and talk about musical chairs is you look at a situation like right now where I like my property, but maybe I want something bigger, better,
nicer, right? Yeah.
People have been sitting for X amount of years now saying, I want to make a move, and they're waiting for rates to come down. So when everyone makes that move at once, I think it'd be an explosion in the market, a rubber band kind of contracting back out. I'm bullish.
Yeah, and then once again, we go back to COVID times where you had 50 offers, 30 offers, 50,000, 100,000 above asking, right? Whereas right now, it's really the time to create some sort of opportunity because whatever buyers are out there, the few that are out there are very, very serious, but still emotional, which is why we have some of those cancellations.
Or seriously emotional. Put them
Yeah. Yeah.
Sorry.
Right.
That's what I'm call. But we're gonna edit that one out, right? No, I'm teasing.
Yeah, that's right.
So the next thing is estate planning. So think about the transfer of wealth, right? I live in Manhattan Beach. Sometimes I get up. I feel like I'm the only person wearing a suit at my block. I'm like, do y'all go to work? Am I the only one? I know it's probably in my head, but I'm like, am I the only one not getting?
No, I was thinking the exact same thing last week, but yet I was walking down Hermosa Beach, at 8 a.m. and I'm like questioning, like, what do all these people do for work? And I'm like,
yoga mats.
I'm one of them.
I walk my dog on that strand all the time right there. And it's wild. You're just like, what is going on here? But I think part of it's a transfer of wealth. $10 trillion is getting passed from the boomer generation to the kids. And it's a tremendous amount of wealth being passed. But here's the problem. Imagine there's husband and wife, right? They have two kids, Bobby and Sally. I'm going to make this up for fun. Like nuclear family. Husband, wife, two kids, and they own an apartment building in Hermosa Beach, right? What happens when the parents pass away? The kids get a step up in basis to fair market value. But now Bobby and Sally own an apartment building in Hermosa Beach. You think they're going to agree upon when to sell it? Sally, she's doing really well, smart. I'll play the stereotypes here. She's really smart. She has a good income. She's like, I like the property. Reminds me of mom and dad. I like to walk past it on the weekends with our dog. And then Bobby's like, I got some credit card and some gambling debts in Vegas. I'm going to get some trouble here. I need money today. This is the biggest thing in trust. Doesn't talk about time. So they got this property and they have disagreement upon when to sell it. But now when they go to sell it, Bobby's like, I think it's worth $7 million. Sally's like, no, it's like 5.5 million, the most, right? Bobby's like, I want my realtor. Sally's like, I want my realtor, right? It's like they're going to disagree upon everything. I've seen this in 20 years. I've seen it. A lot of good kids give any two good kids money, see what happens when parents pass away. Here's the other problem too. A lot of these kids don't want to manage property. They want to go to Coachella at 110-degree weather, wait in line for 10 hours. They don't want to manage the real estate. They want to go to Hawaii. They don't have aspirations of managing real estate, So burning your kids with that. Now in a DST, what happens is say it's a 6-year DST. Parents die in year 3. And let's say it's in their estate plan. It's in their trust, right? Revocable living trust, which means it goes to Bobby and Sally 50-50 upon death, right? Their trust separates them so it doesn't go to probate as well with the state. But what happens is when parents pass away, the kids are probably going to get some stocks, some bonds, some mutual funds, maybe an annuity contract, whatever's left over, right? Insurance. But the real estate's not instant, right? Let's say it's a 6-year DST. Parents pass away in year 3. The kids get a step up. Now the income is split 50-50 for 3 more years. After 3 years, the DST is sold. One kid might say, you know what? I'm going to go this direction. One can go that direction. See, they're not tied to the hip. Their money is separated into 2 different qualified intermediary accounts to go 2 different directions in life. But imagine this too. After the step up in year 3, maybe it's 2019. And what happened after 2019 to 2022? Market went through the roof, right? So maybe there's been a run up in the market since the parent's death. One kid can exchange again and defer those taxes, the new taxes. One kid can pay the small tax bill and move on. but it separates the kids upon death. And estate planning attorneys love this because you don't want to burden your kids with something they don't know how to manage, don't want to manage, and it's going to allow your kids to fight upon death. You're going to be dead. You're not going to know they're fighting, but it's not a good thing, right? You don't want
We've
to.
seen a lot of that. We've seen a lot of that this year, Dana and I. And you know, it's that in some situations they have a will but didn't have it in a trust, or if it's in a trust, the first thing siblings want to do is sell the property, which goes to show you that, you know, a lot of our landlords that are listening to the call, we think about our family members, we think about our kids, and we want to transfer wealth to them. But what we really should be transferring as well is knowledge, right? On how they can keep it, how they can multiply it, or explore other alternatives if they don't see eye to eye, which usually is the case, especially when siblings have, you know, married and had families. Now you've got other people involved. So it just becomes this issue that we see time and time again, where more often than not, they want to sell it, they want to split it, and then everyone goes their own separate ways. But a lot of friction during that process, right? Because they don't see eye to eye on the sales price, on terms, and etc. So to your point, yes.
And Robert Kiyosaki talks about passive income, right? And a lot of times it's their real estate, they can live off the income, like the Richest Man in Babylon book, live off the income and not the principal. And what it does is it gives kids kind of a cooling off period. It gives them maybe 3 years to go blow some other stuff, but now they have the real estate saying, you know what, I want to live off the income. I'm not going to buy the Ferrari in year one, because it's very common. The kids get a lot of money and they're not disciplined enough. Most people aren't, when they get a large sum of money, to go and spend it or understand, live off the income, don't go into the principal on it. So
I really like when you said
they don't understand management, right?
What was that?
I said many times it's because they also are afraid to manage the property and the responsibility that comes with it. So not understanding how to leverage a property management company or having someone to run things for them, right? So sorry, Dana, I didn't mean to cut you off.
You're fine. I was just gonna say too that, like, I loved hearing about the story about having the siblings where the parents died and it was in a DST, that one of them could get out of it, right? If they just wanted to cash out, pay those extra gains, and then take their money, and the other one could continue to 1031 exchange it, right? And I hadn't heard of that, because you always see one, they either have to do one or the other. So I think that's a really great option to think about, you know, for if there's multiple kids through after the parents die, they can make their own decisions on how they want to financially move forward, which is great to have that option. So
because in the DST itself, upon death, it's written in there. So what happens is their money, when it gets separated into 2 different qualified, 4 different qualified intermediary accounts. So they each have their own separate little escrow going on where they can do whatever they want to do with it. And it gives them all opportunities. And there's nothing to fight about, because it's all a preconceived direction. And if they're mad at anyone, maybe it's their parents, but not each other, right? They're saying, right. Oh, they got my income, great. It's like to watch Succession or any TV show. They're always fighting over money. There's something, someone got something. I've seen family members fight over pictures. You know, like, I mean,
yeah, we deal with all of that and try to mediate between everyone. But yeah, I mean, I think these are conversations to be had with family members. So I'm very grateful for your time today. I think a lot of the questions, we were going to do a Q&A, but we have to wrap up soon. But some of the questions that I'm seeing here, we've already kind of answered. Can I build an ADU on multifamily property? Yes, you can. What's the best strategy right now? Buy and hold, value add, and midterm rentals. I kind of talked about that. I would say, obviously, always run your numbers long term, but midterm is a great strategy right now. But what are you kind of seeing, Charles? What's working right now? Like, what are people doing in California or nationwide?
Well, a lot of our DSTs are out of state. Almost all of them, most DSTs are out of state, and it's no offense to California, good opportunities here. It's just that we get better income opportunities out of state in different cap rate situations, where the price of the building in Texas for the amount of rent you get, it's different, and it's going to give you a higher cash flow. But we're also concerned about Prop 33s of the world, rent controls.
Yes.
It's hard to evict people. You know, it's really hard to evict people. And so we're going to states that are more landlord friendly than tenant friendly, and because it's less litigation to deal with, if something were to come up.
Right.
So that's what I was seeing a lot of times is people want to continue living here, but they want some of their properties outside of California, just to diversify. But it's hard to manage properties out of state unless you have an inland managing it for you, and which is one that I see. So we see that that's the trend right now, and we see DSTs picking up as it's harder to find inventory,
Right.
harder to do on your own, or people are aging out. That I got 3 of these. I'm turning 49 in November. I got 3 of these already. I'm starting to think about I got other things I want to do than manage real estate necessarily.
Exactly. Yeah, and I mean, if you think about it, there's just so much that goes into passive income. Nothing's really passive. You have to be involved one way or another, whether it's managing the people that will manage the assets for you, right? Like nobody's going to do that work for you. So you're still having to be very involved throughout the process. And a lot of our landlords live out of state. So I know many of you who are listening to this, if you're having thoughts and you want to schedule a consultation with Charles, I'm going to go ahead and send you guys his presentation. And then feel free to ask him any questions directly. Same with Dana. If it comes down to any title questions, maybe you don't have your property in a trust, which you should, if you haven't already, reach out to us and we can help you through that process. Awesome. Well, any closing thoughts, anything you have coming up, Charles, that you want to share with us?
We do a monthly event in different markets in California. So in San Diego, at the Ruth's Chris and Del Mar, I do a monthly event, educational. It's a free lunch. Everyone wants to come. A little steak and information is not a bad thing, right? We do it in Orange County at South Coast Plaza, at the Capitol Grille, South Coast Plaza every month. Tomorrow in Beverly Hills, if you're in the Beverly Hills area, at Ocean Prime, we be our guest. Just hit up and we'll invite you out. You're both welcome to come as well. And Thursday in Pasadena. So Ocean Prime tomorrow, 11:30 a.m. in Beverly Hills. Just show up. As well as Fleming's in Pasadena this Thursday off 179 East Colorado. We'll be having an event there as well. We're renting out the entire Fleming's and the entire big room at Ocean Prime tomorrow. So just come out to our events. We have a whole panel of folks, and we get deeper into this conversation, and love to have you all there. So
that's good. Thank you.
Amazing. Yeah, you have a lot going on.
Oh yeah, we get around.
Yeah, that's great. Yeah. All right. Well, hopefully I can make it out to one of your events. I will also share some of the stuff that we have going on, always wanting to stay active and keep growing the investor community and show you guys what's working, what's not working, and what you should be considering in this type of market. So thank you guys again. Thank you, Charles, Dana. We'll go ahead and have this on our YouTube channel. If you missed half of it or most of it, you can go back and replay, and make sure to reach out to Charles. Thanks, guys.
Thank you. Have a good day.
Thank you. That was awesome.